So we've got a few things on offer this week, but compared to what's on offer next week, you might want to think of this as the calm before next week's storm. Hello, everyone. Monty here, market analyst at IGUE. And as always, got ourselves quite a few things to process. We're going to start with the recent events, just in terms of the debt ceiling. The fact that legislation is passed nice and smooth. We're clear on that front, and not only the matter that we're not looking at just 2025 in terms of when we have to worry about this again, but also the fact that that's when, at the end of 2025, is when you got those 2017 tax cuts due to expire. And so that just means that we're basically waiting until after the elections, unless there's going to be some big change. But 2025 is really going to be a year where we're expecting some sort of big changes in fiscal policy. But that means for the time being, though, we can relax, take a step back. It also means investors can take a sigh of relief in the sense that they shouldn't be expecting any tax increases between now and then, especially because if it was this difficult to try and get the debt ceiling deal, it means it's going to be quite difficult to get any legislation in terms of taxes passed between now and then. So for the time being, we can sort of shelve this whole issue until 2025. We did get some Fed speak late last week. This is prior to the NFP got Harker, but this really pushed the narrative or helped push that narrative for market pricing, courtesy of Refinitiv, that's showing that we're going to be pausing in June, or by majority pricing that it's going to be a pause in June out of the Federal Reserve in their meeting next week. And after the hike, is basically we're going for a skip, and that means it's going to be a rate increase in July. But him saying that we're at the point or very close to the point of being in restrictive territory. Obviously, CPI next Tuesday could change that narrative quite a bit in terms of whether or not we're looking at a rate hike in the June meet versus July, or maybe we won't see a rate hike at all. But for the time being, that really helped push market pricing in that direction. We also had some manufacturing data. It was a miss in contraction territory, sub 50. It's great that manufacturing, it's a significant part of GDP, but nowhere near as strong when it comes to services. It was also nice that when it comes to prices paid, it did go into contraction from 53 down to 50 to 44. So that's a positive on the pricing front. What about when it comes to the labor market? Friday's NFP reading 339K, better than expected, much better than expected. You had upward revisions for March and April. That reading was for the month of May. But here's the thing, and as has been the case so far, whenever we're getting any economic data, usually there are weak points within it. And when it comes to the labor market as well, it's very difficult to classify it as a strong labor market. Better to classify it potentially in some areas as being more of a tight labor market. Reason being, well, that was the establishment survey at 339K. You look at the household survey, in retreat, 310K, and the unemployment rate based off of that rising from 3.4 to 3.7%. I've mentioned in previous videos that, look, we don't need to worry just yet, but obviously that's something that we're going to have to know, that divergence between establishment and household surveys. And when it comes to wage growth, as expected, month on month, 0.3%, but it's that strong figure last time around is 0.5%, revised lower to 0.4%, year-on-year slight miss at 4.3%, and average weekly hours dropping from 34.4 to 34.3. So in all, clearly some weak points. If you want to look at it as a labor market, say these are some weak points, but from an inflationary standpoint, so far, moving in the right direction, and that's something that's seen as a relative strength when it comes to the markets. Now, in terms of, for today, we got a few things, or I want to say 3 of the 11 stock sectors that might be a little bit more wobbly than expected for a Monday. Energy, due to what's happened on the price front. I'm going to go ahead and pull up IG's trading platform, taking a look here at oil, U.S. crude on the platform. This is WTI, gapping higher, and that's because we had the OPEC Plus meet, where the voluntary cuts that were agreed prior to the meeting that were supposed to expire at the end of this year, due to expire at the end of next year. But then you had Saudi Arabia with a voluntary 1 million cut for the month of July, but where it could be extended thereafter. So far, the story has been one of everyone's sort of been waiting for the reopening. I'm speaking globally, reopening out of China. We don't know how much they have in reserves in terms of oil, but the expectation is that that's considered to be a relative test, in the sense that whenever oil prices are high, they sort of dip into the reserves. We don't know to the extent that that occurs, but we do know that sort of refiners pulling back whenever that does occur. And I'm just going to go ahead and pull up our weekly market report. The link to this report is available in the description of this video. You take a look at this, and retail trader buys so far, heavy buy, actually a couple of percentage points shy of extreme buy territory, unchanged since the start of last week at 76%. Week on week, there wasn't a big change, and that's the reason why it's stuck at 76%. I know we had this gap higher and everything, but if you're looking at it from a weekly time frame, not that big of a change so far. And when you look at COT speculators, so that's where we've had a pullback on the contract from their majority buy, heavy buy at that, but dropping from 72% to 67%. Haven't seen this lower reading since, I believe, on this contract around 2017. So shorts, there was a sizable increase in shorts. They're not buying it just yet. We're going to have to wait and see to what extent those shorts are going to get punished. They clearly got punished at the open, given that oil prices gapped higher, but they're going to see a much more sizable move in order for for the real test to start in terms of punishment for that. But let's go ahead and pull back when it comes to some of the other items that we can expect in terms of sector performance today. The other item is telecommunications got hit. A lot of those shares got hit late last week because of those rumors / fact. No, wait a minute, it's not true out of Amazon with regards to wireless. So we did see telecoms suffering quite a bit. You might see a bit more movement today, and on the financials front, because we do have the Treasury issuing with $170 billion worth of bills today. They got to refill the Treasury general account, though given the fact that we've got, $2 trillion plus in the reverse repo market, bank reserves, you've got a sizable amount, there should be more than enough to fill it for the time being. It's just a matter of where is that funding going to come, where's that liquidity going to be taken from. So I do think that financials might be a little bit more, I want to say it's something that you want to note today and over the coming days when it comes to these three sectors. What about, though, when it comes to the week ahead? Well, we've got services PMIs on offer today. In fact, it's going to get lighter as we progress to the end of the week. It's usually the opposite, right? You usually have some impacting stuff from like Wednesday or Tuesday onwards, and it gets really heavy to Friday like we had last week with NFP. But in this case, it's actually it's going to be a little bit in reverse in terms of impacting items, just because services PMIs, they're going to be today far more crucial compared to, say, manufacturing, far more crucial to GDP and to growth in general, not necessarily more crucial when it comes to, say, energy or commodities that usually rely more on manufacturing. That's where you want to see manufacturing boost, especially when it comes to Chinese PMIs. But it's been strong and healthy for both Japan, better than expected for China, above 50 readings, and expected to be the case for the rest. For the U.S., we got S&P Global as well as ISM, and obviously we're going to be noting the lattice components, its pricing component. To what extent is it going to drop? Is it going to drop to 59, say 58 as expected? Well, definitely something to note. And then of course we got ourselves the central bank policy announcements. Among CFX majors, it's Reserve Bank of Australia tomorrow morning. It's the Bank of Canada on Wednesday. I know both of them had to contend with stronger than expected data on the pricing front for the RBA. BoC, not just when it comes to pricing, you also had GDP stronger than expected. Employment data was stronger than expected. Their employment figures are going to be on this Friday, but they've had stronger than expected data, which means that market pricing, it's been showing that the possibility of a rate hike, but via majority, it's on hold. So I want to say that there's a strong chance that we'll get a hawkish hold from both of them, and potentially pushing out a rate hike out of the RBA until their next meeting. But that's what to expect from the two of those, for those of you trading the Australian dollar as well as the Canadian dollar. Otherwise, out of the US, it's, once we get past services PMI, it's going to be pretty light. I know there's, trade, but otherwise the usual weekly items, inventory data, mortgage applications, unemployment claims. And out of China, we are going to be getting, we got the services PMI this morning, we got trade data on Wednesday, and we got both CPI as well as producer prices on Friday. So that's about it from our end. I wish you guys the best and happy ticks.